Hello, good afternoon, ladies and gentlemen. In the last few years, what we have discussed and deliberated is on the various facets of shareholders agreement, right? What are the things that are there in the term sheets? What are the things that investors as well as the founders should be careful about while uh, going to any term sheet or SHA? In this webinar, what we are trying to understand and analyze is what are the two important factors that there is in term sheet, and how should one approach these factors, what are the things they should see, and what are the things they can give a miss. In this webinar, we will discuss on the reserve matters or affirmative voting rights, along with the liquidation preference clause. These two clauses are there in almost all SHAs and term sheets. So this needs to be reviewed and understood very carefully, because these are the things that have long-term consequences, right? So me and my colleague ET will be trying to review each of these two clauses and what are the various facets on this. Lastly, we will also try to understand through case study what are the things that are there in this two clause and how we can help navigating through the different complexities of this clause. So without further ado, let us start this webinar. In this webinar, we are trying to understand these two clauses, which has rights impact on the rights of the investors, in the rights of the founders, in the rights of the CXOs and other key stakeholders. These two rights, that is affirmative voting rights and liquidation preference clause, has impact not only in a short-term basis, but on a long-term basis. So these two clauses are very, very important and are often negotiated between the investors and the founders, and hence it is very much important to understand the impact of these two clauses, right? First, let us understand what are the different sort of rights that are there in this shareholders agreement. In the shareholders agreement, we think about the ownership proportion, the voting rights, the majority, the investors' right, the majority shareholders' right, the minority shareholders' right. What is the right during the time of exit? What are the rights that during the time of acquisition of the startups? How these things are impacted, the tag along rights, the inspection rights, where the shareholders or the investors have the right to inspect all the books of accounts, the minute book and everything. And of course, the rights of, in case something goes south, how to navigate to the suing or the legal rights of these investors. Now, two major clause that is there in the term sheet and the shareholders agreement would be the affirmative voting rights and liquidation preference right. Now, what are the affirmative voting rights? These are restrictive rights. It's also called restrictive matters, right? In this rights, the investors have veto or some sort of a protection through which in certain issues they can have their sort of decisions being taken into consideration before taking it. So say, for example, I want to change the directors, right, in my startup. And if the affirmative voting rights in my shareholders agreement is there, I have to take their, that is the investors' approval, and only then I can take it. So prior approval of the investors are needed on this sort of rights. So say, for example, there are several clauses, right, in this sort of agreements. Like, so say, for example, the change in shareholding structure of the company, right? The charter documents, the MOA, AOA, the object clause of the company. If I have to remove the directors, if I have to remove the auditors of the company, I have to take the approval of the investors. If I have to issue new shares, right? Now, the reason the issuance of shares are very common in reserve matters is simply because the moment you issue more shares, the existing investor shares will dilute, right? So they have the veto that whether the company will go for the new rights or not. As for the founders are concerned, it's negotiated. These are the things where the founders say this will impact their decision-making ability. So they might choose to reduce the issuance of capital in the affirmative voting rights section. Now, there again is dilution. There are dilution protections are there in the agreement. So in case there is a dilution due to affirmative voting rights, the shareholders might be compensated. Now, there are several mechanisms through it. So say, for example, if the dilution happens due to a down round. Now, what is down round? If down round is a investment phenomena wherein the startup raise a capital at a lesser price vis-a-vis the existing sort of round, right? So if I raise at a seed round at a $10 million, and due to the market condition, my next round is happening on a $9 million, the existing investors will be compensated due to it. So these are the things that are there in affirmative voting rights. If there is a change in business activities, if there is any debt more than a particular amount, in fact, if the CXOs are paid more than a particular amount, then that can also be a part of affirmative voting right. So say, for example, if the founders pay itself almost 2% or 3% of the funding amount, right? Now the investors would not want that to happen. The investors would like, I mean, at least the seed investors would like the investment amount to be spent in the working capital requirement of the company on the operational level rather than paying salaries of the founders, right? So these are the things that has to be kept in the term sheet and the SHAs as part of affirmative voting matters altogether. So let us understand through the various sections of Companies Act on how this affirmative voting rights are there, and in case what are the sort of complexities in DVRs and other mechanisms that can be addressed through this affirmative voting rights, and how DVR can be used in issuance of affirmative voting rights. Iti, can you help us to understand this?
Yeah, sure, Shaumik. Hello, everyone. So we're trying to demonstrate how affirmative voting matters work in case of in SHAs or investment agreement where particular VCs or the various types of investors take part. So in this example, we've tried to put in that say promoters are having or holding a 78% stake in the company, and the investors are having 22% stakes in the company. Now, the investors have rejected resolutions that is ought to be that has been approved by the promoters by exercising their voting rights. So, how will the resolutions be said to be passed or not? So, in the now, just to present the facts of the case, now, Companies Act, it provides for issue of equity shares with differential rights. Say we can give investors voting rights. We can give investors differential voting rights. We can give investors dividend rights. We can give investors liquidation preference right, which we are going to discuss in the future course of action in this webinar. And so different types of rights the investors can have in terms of their shareholding in the company, be it a issue of equity or be it an issue of preference shares. And so in this case, the promoters were issued a class of shares which were the normal the vanilla equity shares, and the investors were issued shares with the different voting rights, or special equity shares with special voting rights. So this must be the case in our presented example. Now the investors obviously infusing funds in the company and having minority stake, they have taken certain special rights from the company. Like rights they have been allotted are the affirmative voting matters, where they are going to mandatorily, and their vote will have to be mandatorily counted to present or to approve any kind of resolution. Affirmative voting matters, then the investors take the other voting rights, or they even take rights in terms of tag, and they even take rights in terms of drag. All these kinds of rights, these right of first refusal, preemptive rights, these are the rights that the investors usually take in their agreement. Now in this case, they have taken special voting rights, wherein they have been allotted, suppose a 2 vote per share, or a 3 vote per share. It has been provided accordingly as per that. Now now the Companies Act, and the major practice that is followed is that usually the investors agreement, they are the all the rights of the investors, or wherever any kind of entrenchment or any kind of alteration is required for a private company, it is infused in their articles of association. So this phenomenon is called entrenchment of articles of association. So now, considering all the rights that the investors have been provided in the SHA, those are the rights that have been provided in the those are the rights that have already been provided in the AOA. Now, since affirmative voting matters are the rights that have been approved in the AOA, and if the investors are not casting their vote in any kind of resolution where in any kind of event or resolution where their mandatory vote is requirement, the company cannot infuse, or cannot the company cannot put in, or bring the company cannot enforce such resolution without the permission of the company. The agreement in such case would become void ab initio, and the investors might infuse or take charge, or any kind of impose their liabilities, their rights in such case. So affirmative voting matters becomes a really important rights of the investors who invest heavily in the company and for a minority stake only.
Right. Thanks, ET, to making us understand through some case laws in this regard. Now, coming to the next point is liquidation preference. Now, what is liquidation preference? Liquidation preference is nothing but the factor wherein the investors will get the protection during the time of liquidation. So say, for example, if the company doesn't go through and it goes south again, in terms of liquidation, and if there is a money saved during liquidity event, the first rights goes to the investors. Now, this is not only in case of bankrupt, it's also in the case of selling out. So if the definition in the SHA mentions that the liquidation events also triggers if there's acquisition of the company, then also the primarily and the first exit will go to the investors, and then the founders will get their money worth. So during the time of liquidation, bankruptcy, or in case of or in case of acquisition, this liquidation will trigger in. Right now, this liquidation preference have various stakes involved. There are various type of liquidation preference. One is, of course, participating. The other is non-participating. Let us help us, the viewers, understand what are the different sort of participating and non-participating liquidation preference, and what are the case laws that are around this liquidation preference clause.
Yeah, thanks, Shamik. Taking the discussion further. We are now going to discuss what are the different types of preference, liquidation preference that are generally given to the investors. Now there are basically two types of liquidation preference are given. First is the participating liquidation preference, and the other one is the non-participating liquidation. Now, what is participating and what is non-participating? We are also going to discuss that. Now, primarily non-participating preference shares are the state preference shares. Now, what happens in this scenario is that the company is given a multiple, the company is given the investors basically. Now what happens is that the investment amount is decided upon by the investor and the company, and the company basically gives multiples of that investment amount by attributing whatever the proceeds of the liquidation preference has been received. Say for example, if any kind of investor is investing, say 1 million into the company. So as per the clause and whatever the proceeds are, the investor will receive, say a 1x or a 2x or a 3x, whatever has been decided. They will receive that of the investment amount, multiple of whatever investment amount has been given in the company, invested in the company. The investors are going to receive multiples of that, or whatever x has been decided by the investor and the company in the agreement. They are going to get that of the proceeds. Now, in case of participating liquidation preference, what happens is that the liquidation it just moves further from the non-participating liquidation preference mechanism. Now, what happens in this scenario is that the investor is receiving their guaranteed return. So now if an investor is investing, say, $1 million in the company, they will get that $1 million in the company. But the investor will also be entitled to participate in the remaining proceeds of the company as well. So now say they are saying that in the remaining proceeds of the company, they are going to be entitled for say a 25% thing. So the investors will get their invested portion as well, and now they will also have the right to participate in the remaining proceeds of the company, in the remaining proceeds in proportion of their shareholding or whatever a predetermined a percentage or predetermined portion has been decided. The investor will also write over that. Since the investors are getting two rights here, one is the minimum balance, the minimum investment amount they are going to take out, and the right to invest in the company in proportion of their shares or the predetermined percentage. This double rights the investors that get. Now this is called, that is the reason this is called a double dip. Now liquidation preference when happens in common scenario, why liquidation preference happens is because of triggering of certain events. Now such events are called liquidity events. Now liquidity event is an event, say an acquisition, a company bringing up IPO, say a merger, or a company or the founders, they are diluting their stake by more than 50%. They are handing over control of the company to any other person. So these are the events wherein the control of the company is moving out from the founder's hand or the promoter's hand. This triggers liquidity event. So what are the major pointers for the liquidity event? We are going to discuss this further. Now, liquidity event, it can provide exit opportunities to the investors or shareholders, and they can also allow them to convert their investments or shares into cash. So this triggering of a liquidity event will obviously bring in liquidation preference, and once liquidation preference comes in, the investors, they are given an exit opportunity and the investors exit from the company. Now, liquidity event can obviously, once liquidity event is happening, then all the illiquid shares of the company, they are going to be encashed, and it becomes a source of funding from the company as well. when the company says, for example, when the company is bringing up an IPO, or where the company are where the companies are selling the shares to the public. So all these scenarios, they also trigger liquidity event, and this also becomes a source of funding. And it also, liquidity event also is they serves the purpose of growth from the companies, growth for the companies. So they allow the founders and the venture capitalists to monetize their investment and realize a return on their investment, thereby providing them for exit from the company. Now, how this liquidation preference work is how we are going to discuss this. Liquidation preference. Now, if you see the presentation, the liquidation preference. Now, the proceeds as a prima facie thing, on a first note, the preferred shareholders, they get their portion of the shares. So we are only talking about the shareholders here. We are not talking about the debts and everything of the company. So we are just presenting here how common participating and non-participating shareholders work, liquidation preference work in liquidation preference scenario. So primarily the preferred gets their paid, that whatever the multiples they are going to have, they are going to get it paid. Now then comes the participating preferred shares. So they then get a substantial portion of the shares, where the participating and non-participating, they get their portion. At Then comes the participating investors, where they are going to get the 2x, the non-participating investors, where they get 2x or 3x the multiples of their capital. Whatever the capital they are having, they get that. And post that, there is a conversion threshold, how the other things or how the conversion is going to happen. So these are how the conversion is going to happen, between whatever the ratio that has been predetermined, or whatever the ratio or the threshold is. So this is how liquidation preference, it impacts their proceed. Majorly, the preferred, they take the shareholding, which is a non-participating one. Then comes the participating one, and then the small portion of their shares, it get divided. The small portion of the proceeds, it get divided commonly between the participating and the non-participating ones. Now we are further going to discuss how liquidation preference, it works via calculation examples. So taking all the discussion further, we are going to discuss how the investors are receiving funds when there is a participating factor, when there is non-participating factor, and when there is actually no liquidation preference. So, say now, as per our examples set forth, there are four potential outcomes for an investor. Say, investor is investing. If say an investor is investing only a $10 million in the company, and that is for a 30% stake. And now the company is at a later stage being sold out for 20 million. Now, we have discussed different scenarios, how this $10 million and how the investor's stake will work in case there is liquidation preference, in the case there is non-participating liquidation preference, and in case there is participating liquidation preference. Now, in case when there is no liquidation preference, so investor investing a 10 million for a 30% of the company, they are going to get 30% of the proceeds. Say now, or 30% of 20 million comes to 6 million. So the 20%, 30% of the 20 million, it comes to 6 million. So the investors are going to get a $6 million out of it, and losing how, while the common shareholders will receive mostly mostly $24 million. The remaining proceeds will be divided into the the common equity shareholders. Now, on the next instance, say there is a non-participating liquidation preference at 1x. So the investor who has invested a 10 million from at 1x preference will commonly get only 1 million, and the remaining 20 million will be divided into all the other portions and all the other remaining equity shareholders. At the other instance, now if there is a participating liquidation preference at 1x liquidation preference, now in this case, now see how the participating thing works. Now preferred investors, they get 10 million of their firstly they will get their minimum threshold amount, that is 10 million they have invested in the company. Out of the 30 million, they are going to get 3 million. They are going to get 10 million out of that 30 million. Now, the remaining, now out of the remaining proceeds also, they are going to get 30% of their stake. Since they were involved for 30% stake of the company, from the remaining threshold also, the investors will be liable to get another $3 million. Now, the total the investors take out from the $20 million is 30 million, and then the common shareholders will receive the remaining portion, that is the $7 million.
Right. Thanks, E.T. I think we have covered the various facets in this regard. We have tried to make the viewers understand through various case laws and examples of the various type of liquidation preference event and the affirmative voting rights clauses that needs to be understood in deep so as to give the right perspective to the stakeholders, be it the investors or the founders. So in case of any questions in this regard, please feel free to write to us at customersuccess@taxmentor.com, or if you have any requirement in regards to reviewing your term sheet or the shareholders agreement, or for that matter drafting it, we would be glad to assist. We help both the investors and the founders in reviewing this and drafting this, and we can definitely work synergy with the concerned person and take this forward. Thank you so much for coming to this webinar, and we will come back next week with similar sort of webinars accordingly. Thank you so much. Bye-bye.